So now, Andrew, you guys have for your dividend factor-based ETFs, you've constructed some proprietary indices to use as the basis for the factor. Can you talk about that a little bit?
Yeah, so it's interesting. So we've leveraged Fidelity Management Research and Company. So that's our quantitative team down in Boston, Fidelity Company Group. So what they actually do is they all worked alongside active portfolio managers since about 2006. And what I found most interesting about our team, it's about 20 quants, so PhDs, MBAs, you name it. They actually don't sit together. Their job was to support active portfolio managers. So that it could be the value team, the growth team, the equity income team in the case of dividends. So they took those insights from working alongside the equity income portfolio managers, and they developed this portfolio construction methodology. So we screened the universe of, let's call it, the largest 1,000 stocks within the U.S. equity framework. And what they do there is they apply screening criteria. So they look at dividend yield, they look at payout ratio. So payout ratio is pretty important in the sense it gives a higher quality focus. So remove some of those companies that are at risk of cutting their dividends. So if the earnings are less than the dividend payment, that dividend is likely not sustainable. And then lastly, dividend growth. So what we've seen is historically, dividend growers tend to be a little bit more upside participation than dividend payers, which are more stable, mature companies. But I think where it actually comes down to the soup and nuts, which I find very interesting, is portfolio construction. So if you think about dividend ETFs in general, you can weight it by market cap, you can weight it by yield, you can weight it by equal weight, so every single company represents the same weight. But what we found is that can create unintended risks. So sector concentration, I think, is probably the front and foremost. So that's where a product takes you, let's call it 65% in a single sector. That single sector return profile can run the whole return profile of the ETF if you have significant exposure there. Second is company bets. So if you think about it, if we're going to weight based on yield, you might have a company represent a larger proportion relative to the broad universe than maybe it does or maybe it should. And then lastly is market cap biases. So if you think about it, when you think about dividends, we're thinking about mega cap, high quality, large cap stocks. We've seen some indices out there actually bring in a small and mid cap bias. So what we try to do is remove all those biases. So what we're trying to get to is let the dividend factor shine through, let that drive the return profile, and try and eliminate a single sector concentration risk, company bet risk, as well as market cap biases. So I think from the portfolio construction angle, we've done a pretty good job of letting the dividend factor drive the return profile.
What would you say is the differentiating factor between Fidelity and other ETF manufacturers?
I think it's leveraging those fundamental insights.
Yeah.
So in the sense that our guys actually, first and foremost job was to work alongside our active portfolio managers and then taking that experience and those insights and then applying it to the ETF business, which we see today. So we launched our first suite actually in 2016 down in the United States. We went 2017 on the London Stock Exchange, and now we're excited to bring that to Canada in 2018.
I think what a lot of folks might not realize is that you guys have had this in the sandbox for quite some time. I mean, as far back as 2006.
Yeah, it's a pretty interesting story.